Good morning. Good morning. Happy Saturday. I hope that everyone is feeling well on this morning. Just drop in the chat one word. How are you doing today? Good morning. Good morning. Happy Saturday. I hope that everyone is feeling well on this morning. Just drop in the chat one word. All right. Can everyone hear me now? I see Mr. Terry says he is blessed in the chat. Amen and amen. Me too. It is a beautiful Saturday morning, and we thank you all so much for your flexibility. I know that we were intending to be in person today, but listen, one thing about life is that we learn how to pivot, we learn how to maneuver, we know how to be agile in this space. We are so happy to have you all with us this morning. And if that's all right with you, I just want to make everyone aware that we are also going live today on our YouTube channel at the Kingdom Wealth Connector. So I'm going to give you about 60 seconds to go tell a friend to either jump into the Zoom room or meet us on YouTube. We're going to get started in just a moment. I'm just so happy to see you all. So Mr. Terry was the only one to let us know how he was doing. Adrian says she's fantastic. Miss Eudora and Tia, Miss Nyla, how are y'all feeling today? And while you all are typing that information in the chat, I am going to pull up my screen and you all are going to give me a big old thumbs up if you can see our screen. Do I see a thumb? Do I see one? Do I see two? Can everyone see the screen? Wonderful. Is our audio also clear? Everyone feels good, hear us very clearly? Wonderful, wonderful, wonderful. Again, welcome in. I see a few more people coming into the Zoom room. Just a couple of really quick house rules before we get started with today's presentation. As you all are coming in and maneuvering, I know some of us may be multitasking and tackling the day, but please try to keep yourselves on mute unless you have been called to speak or answer your questions. We want to try to make sure that we're avoiding any type of background noises for any of our speakers. Also, at any point during our presentation that you have a question, please do not hesitate to put your questions in the chat. We will address everyone's questions, I promise, but we are going to segment our questions based on the particular presenter at the time. So what do you mean by that, Lyndsae? We have 3 awesome guests that you're going to hear from today, and I'm going to introduce everyone momentarily. But After each person presents, we're going to open up Q&A so that you don't forget anything as we move along from one speaker to the next person, okay? I will be your first presenter. Then we're going to have our amazing loan officer, Miss Edie Jenkins. And then last but most certainly not least, we have our licensed insurance and investments professional, Miss Adrienne Harris, who is going to also give you guys some important gems. And after each person, you can definitely ask your questions. We will be monitoring questions both here in the Zoom chat, but also while we are live on YouTube. If y'all are ready, I need you to let me know that you are ready in the chat, okay? I believe in great energy. We're going to bring you all some wonderful energy on today, but I want to make sure that you can give it back to us, okay? Your presenters want to feel loved and appreciated and supported today. So just type in the chat. If you're ready, say, I am ready in the chat. I see one, I see two. Who else? Who else ready? And we family here. So if I call your name, it's all love. That's just because I want you to engage with us. Will gave us his thumbs up. Hello, Mr. Honolulu. Good to see you. Listen, we are going to get started. Terry said, I am beyond ready. Okay, that is the energy that we are absolutely looking for on this beautiful Saturday morning. India says she is ready. Listen, we gonna jump right on in. How do I jump to the end of the presentation? Look, technology. But guess what? Here we are. Good morning and welcome to our Spring into Homeownership workshop, your path to keys and equity. If you did not know, guess what? It is your season to unlock stability, security, and legacy. If you were here a little earlier, then you heard us start with our theme song for today. You will win. I don't care what your life circumstances may be or have been. I don't care what everybody else is doing around you. And I also don't care, okay? What our beautiful people are doing down there in Washington, D.C. It is still your season to win. You all are going to receive a load of information. And listen, if this is your first homebuyer workshop, it may almost feel like you're drinking from a fire hose, but take what you can get, consume it little by little. Make sure you take some notes and come back to everything else that may seem a little overwhelming after the workshop. Our goal is to make sure that we're delivering this information in a very intentional way, but also in a way that it lands well, that you can best receive it. So listen, buckle up. Does everyone have their notebooks? Because y'all said y'all was ready. So I want to make sure you have your notebooks out or your Word document up so that you can take your notes, even if you're on the go, okay? Make sure that you do not miss out on any information that we're sharing today. My name is Lyndsae Peele, also known as the Kingdom Wealth Connector. I serve as the CEO and licensed realtor with Keys to the Kingdom Real Estate Advisors. I wear a number of hats in this ecosystem, but some of the things that I am the most proud of being is an HBCU alum of the illustrious Howard University. I am an experienced banking professional. I spent a number of years within retail banking, literally from every role, from a teller to a branch manager and everything in between before jumping into entrepreneurship. As I mentioned earlier, I am also a licensed realtor in the state of Maryland. I am also a second generation entrepreneur. So if you know me, if this is not your first time with me, then you know I have a very, very special place in my heart for entrepreneurs. And that's because I grew up on the back of a small business. I saw what it was like firsthand to have parents who were literally getting it out the mud to create the life for me that I have. And I'm so forever grateful. And my life is committed to making sure that every other entrepreneur that has been called to my voice, that has been called to my community, can also gain access to the tools and resources to be successful. Last year, I was named Technically's Real List Connector right here in the city of Baltimore. But one of my proudest accomplishments is that back in 2022, the SBA in the state of Maryland named me as the Financial Services Champion of the Year. Okay. It has been a beautiful decade of being in this work. And let me be honest with you all, I am not new to this. I am very much so true to this. So listen, you are safe here. Thank you for being here. And we hope that you stay with us. We hope that if this is your first introduction, that you are already excited to come back with us. Now, what is the objective of today's workshop? You all know why you're here. One, we want to make sure that we can help you get into your home, right? But we also want to make sure that you have a clear understanding of how that home can create generational wealth for you. Now, I would love to see either a round of hands from reactions, or let me know in the chat how many people have homeowners in their family. Let's see. And I will be one to raise my hands. My parents exposed me to home ownership a little earlier in my life, in which I'm grateful for, but I also know that may not be everybody's story. So let me know if you have homeowners in your family already. Let me know. Or guess what? If you're going to be the first one, if you are going to be that generational curse breaker, also let us know in the chat that I am the first, or I will be the first. All right, Miss Johnson says she has homeowners in her family. She has been exposed. Anyone else? I will be the first. Terry, don't make me put on my shouting shoes, okay? That is exciting. And we're so, so happy to usher you into this season. Shout out to you for putting in the time, putting in the energy, and not being discouraged to join us on today. You are in the right place, I promise you. First of all, why does homeownership matter? Let's just take a moment. 10 seconds. Let's just think about why homeownership still matters even in 2025. Even with the rates not necessarily being our favorite, why is it still important? And it's really for a collective of reasons, right? Yes, of course, it is to make sure that we have stable housing, right? Yes, I think that's the obvious. But homeownership is also important because it provides you with the level of physical stability, right? When you are a renter, and there is nothing wrong with being a renter because I believe that there are seasons for that. But when you're a renter, your housing relies on that landlord. And if they say today, hey, I want to sell this property, or if that property management company in that building say, hey, we want to increase this rent by $1,000, right? When you're renting, you have no other choice but to either oblige or to create a path of your own. I have seen cases where great people have lived in homes over 10 years with landlords. And then all of a sudden, one day, they decided to sell that home. And guess what? The new buyer said, we don't want tenants. And what does that do? That usually gives that tenant maybe a 2-month window to figure out what's next. But if you have rented that space for so long that that has truly become what you have considered your home, that can feel like a form of displacement. And I don't want that for any of you. I want you all to be able to chart your own course on the own four walls that you live in. Or even for my folks here who know that you are an investor deep down inside and you're like, Lyndsae, hey, I'm ready to buy my first house, but it's not going to be my forever home. That's okay too. That's all right too. But we want to get you your keys so that we can get you in a stable position. But we also want to make sure that we understand the importance of the security and the equity that also comes with home ownership. What is equity? And we'll talk about that. Equity is the piece of what you're going to own in that home, especially as we start to slowly get rid of that mortgage. But most importantly, home ownership creates an avenue for you to create a legacy. And you don't have to have children to desire to build a legacy. We all have a purpose and have assignments on our lives. And for a lot of us, home ownership is a part of that. And that is a part of your legacy. But also, real estate can be a solid hedge against inflation. While, yes, your real estate expenses can go up with inflation, like taxes and insurance. However, when you own property and that equity, right, continues to rise, you also give yourself an opportunity to make different decisions. But I think we also know that home ownership is absolutely one of the best wealth building tools that will last generations to generations to generations. I see families who have homes within their lineage that has been there for 4 and 5 different generations. And for everyone who's here, whether you've had that experience or not, you're writing that experience for yourself and everyone else. Terry, shout out to you for starting that trend for your family. We are claiming that that property that you purchased is going to be in your lineage for 5+ generations to come. So while we may look at interest rates or while we may look at prices and sometimes feel defeated, home ownership still matters. So let's help you get into your home. Let's think about your financial readiness for home ownership. Now, as I mentioned, right, earlier, I have been in the industry, the financial space, for a decade. So your average realtor will probably talk more just about the process of finding the home and getting you to settlement. But here with the Kingdom Wealth Connector, we are very intentional about focusing on wealth and finances because it is at the cornerstone of all that we do. The big three in preparing yourself for homeownership. One is your credit health. Let's talk about it. I know oftentimes we might not always be proud of some of the things that might show up in our credit report or our profile, or what I like to call sometimes your financial report card. But I'm here to provide you a safe space of peace and comfort to say that whatever it is, whatever it says, it's okay right now. But we have to pull it. We have to look at it so that we know where those areas of opportunity lie. We need to know, how do we address those things that might have been bogging us down for years? Because I can also be honest, a lot of us didn't necessarily have the best credit health or conversations growing up. We were not getting this education at the dinner table. So for some of us, we've learned how to manage our credit or not manage it through real life experiences. So when you're preparing for home ownership, the first thing that you want to know is where you stand. And in order to do that, you have to pull your credit reports. You gotta pull them. No matter how scary, we have to pull them. And really, really, if you haven't been doing it beyond today, I want you to position yourself to start monitoring your credit on a regular basis, monthly at least. But when you really get into it and you actually start to like it a little bit, I want you logging on every other week just to see how things are going. Where are you? Now, how many folks in here already monitor their credit on an ongoing basis? And if not, it's okay to say not yet, because we're going to start. If you are, or if you are not, one of my favorite recommendations is Experian. You can download the app, you can create your profile, and you will get ongoing updates. And why I love Experian is because they are indeed one of the credit bureaus and one of the credit bureaus that a lot of lenders use. Yes, Equifax and TransUnion are still in the bubble, but Experian has not done me wrong yet. So I am still a fan and will continue to promote them. Now I know we probably have some Credit Karma folks here, and it's all right. However, I do not want you to get fixated on the scores that you see in Credit Karma because they have a different model. They use the Vantage score model versus the FICO model, and your typical lender will be using FICO scores. So you want to make sure you have the most accurate information as you're going through this process. And once you pull your credit report, and you see some areas of opportunity there, if we've had any late payments, missed payments, charge offs, anything that may cause a lender to say, let's pause, start addressing them immediately. Let's dispute any errors that might be there, anything that you did not do, or any just outdated information. Let's remove that. Pay down your debts. You want to make sure, and our lender is going to talk about this, but you want to make sure that your debt to income ratio is in a pretty good position. You want to make sure that your income exceeds your expenses in a favorable way. Pay down those credit accounts, especially those revolving lines like your credit cards, your lines of credit. They're so important to pay down, because they're going to be looking at your utilization. That's going to also help them make a decision. Now, while your full credit card balances are not necessarily what makes up your DTI is made up of those monthly installments that you have, but also the minimum payments on those revolving lines. So if your balance is $100 and that minimum payment is $25, they're going to be adding that $25 to your expenses list. However, they're still looking at how are you managing your credit cards, because they want to see what are your credit habits. Because your mortgage lender, they are usually giving you the largest amount of money for the biggest asset that most people are going to acquire in their lifetime. And they want to make sure that you are not presenting to them as a risk. Take an assessment, have some hard conversations with yourself, and let's clean up our credit. Now, while there is a minimum, right? And that minimum is usually just depending on the product, sometimes 620, sometimes 580, depending on your line of products. And our mortgage lender will get into that. You still don't necessarily want to be at the minimum. You want to try your very, very best to get your score as high as you can get it. Because the higher the score, the better your terms. The lower the score, typically the more money you may pay for that account. Income stability. Do you have consistent income on paper? Heavy on paper. When you're working underneath the table and we're not reporting that income, that will not help you get into your home. We need job consistency, documentation, at least for 2 years. At least. Lenders don't want to see gaps in your employment. And our mortgage lender, I'm pretty sure she's going to mention that. So this is just, if you're hearing it again and you're going to hear it again later, it's because it's important. And even if there has been some inconsistencies, let's look at it. Let's assess it. Can you explain it? Can you give them a proper explanation? But most importantly, are you also documenting all of your income? Now, I know if I have some entrepreneurs in here, we try to fight Uncle Sam with all these taxes. However, I need you documenting your income, because they're going to be looking at that bottom line number. Yes, your gross number is going to be amazing, but they're going to really be looking at that net number. And you want them to feel comfortable and confident in your ability to make this purchase, but maintain this purchase. We don't want to see any of you all falling in foreclosure.
short sales, none of that. We want to make sure that you can get in and stay in and buy more. Hello? But also, let's talk about your savings discipline. Let's break the ice for a second. Now, I know that there are a ton of homeownership grants, down payment assistance programs, all the things. However, I do not want you solely focused on what everybody else is going to give you. What are you bringing to the table for yourself? Because even if you're going to qualify for grant funding, you want that lender to see that you've already started, that you've been trying. Do you have that emergency savings? Do you have that maybe potentially a separate homeownership savings that has enough to cover your closing costs and a little bit of reserves? Can you, if you lost your income a month after you got into your home, can you still make at least a few payments before additional income finds you? And if that is not your story, then we want to make sure that we start to address them. It's very, very important. A tip, don't just save for the keys. Save for the life you'll live after you open that door. I want to get you in your home, but I don't want you to have to sleep on the floor for 3 months because we weren't ready for the after. Let's talk about preparing your documents for pre-approval. Lenders are going to want to see all of your financials. Yes, it's going to feel like they're in your business. They're asking all of the questions, but that is their job. They have to do their due diligence. Even if you have not had the best relationship with banks or lenders before, don't come into it with a pessimistic mindset that, oh, I got to give them all this information. Why, yes, dear. They're about to give you a large sum of money to go and purchase this major asset. You want them to make sure that they're making a good deal. They're going to look at your last 2 years' tax returns, typically. There may be some cases where they don't, just depends on your status, but you want to be prepared because when you stay ready, you don't have to get ready. And especially when you start the process, usually if they're pulling your credit, that report is only going to last them 120 days before they got to pull it again. So you don't want to start and then now you got to go and work to get all of these documents. Now you got to go and rush your CPA to file your taxes. Have these things ready. I tell my clients often, create you a folder, whether it's in your Google Drive or on your computer. Put all of your financial documents in there in advance. Have your returns. Have your statements. Your pay stubs. Your employment verification. And a letter of explanation. How many people know what that is? Excuse me. How many people know what a letter of explanation is? So, let's just say that you went through a period of hard times and your credit report shows that. Unfortunately, your underwriter won't know that. They won't know that you lost your job and were the primary caregiver. They won't know that you had to stop working to take care of your parents. They won't know you went through that messy divorce. For those seasons, write a letter in advance to let them know what happened. Yes, you're exposing them to some additional details about your life, but you rather them see that than to assume negative things about your payment behavior. It's for a reason. A couple of things. And please excuse me if I mute, it's because I'm trying not to cough on audio. My allergies have been kicking my butt all week, but we are here and we show up anyway. A couple of other things that you want to absolutely consider. Do you have a realistic budget? Do you have a budget? And is it accurate and up to date? Is it inclusive of all of your expenses, fixed and discretionary? You want to have a budget for today, but you also want to have a projected new budget for when you get into that home. There are several mortgage calculators out there. Do your homework. See what you can afford. But also, what would those new expenses be? If you're living in an apartment right now, and let's just say in your rent, you have water and sewer included. Let's just say you might have, for some apartments, or for some leases in general, you might have all utilities included. Your maintenance, your upkeep, warranties, someone else is paying for that. But when you get into your home, those expenses are yours now. Can you cover it? When the seasons change, you're using more air than normal in the summer, more heat than normal in the winter. Can you cover those bills? And for my people who are in the Baltimore area, we know that sometimes those BGE bills can be scary. You want to make sure that you can take care of it. Create both budgets. If you're already using a budget today, amazing. If you're not, create you a budget for today so that you know where you are. And then you use that to create a projected budget for once you own your home. Continue paying your bills on time. If you know that you plan to purchase in the next 24 months, really, make sure you're not missing one payment. Not one. And if you're going to be a little late, you call them, let them know, create that rapport so you don't worry about it popping up on your credit report. Your lender may not see that you were a little late just internally in that other merchant system, but they will see whatever shows up on your credit report when they pull it. Be intentional, okay? Make some sacrifices because you're worth it. And your new home is waiting for you on the other side of that. You want to vet out some potential lenders carefully. Now, with me, I'm going to always bring you people that I trust, people that I have vetted. But you want to do your diligence, your due diligence, because not all mortgage products are the same. And not all mortgage lenders are made equal. See who's the best fit for you. Ask them about their experiences. Ask them about the benefits of working with them. But also, see if they have something to offer you. Just FYI, our lender today got some money, okay, to tell you about. You want to ask your lenders those questions. Know that you are the prize. They need you too. Ask questions. Interest rates, terms, hidden fees. Ask them. And if you don't know what to ask, I promise you ChatGPT can give you a list of questions. And be confident because you deserve to know before you sign on the dotted line. Keep saving. Keep saving. I promise you, you do these things with intention, you're going to comfortably get in your home and stay there. Now, we can't tell you what to do without telling you what not to do. Few things to avoid. One, do not make any large purchases before you close. Once we get you under contract, you make no sudden movements with your credit. Okay? None. Do not get excited and go get a matching car for your matching house before you've closed on that home. It can kill your deal. Do not get overly excited and go and get all your furniture. It can kill your deal. No large movements. Please, I beg of you, because it's going to alter your numbers. And now that home that you were ready to put your family in, now you've potentially lost it. Don't do it. Do not open or close any credit accounts without speaking to a professional, but also without letting your mortgage lender know. Have that conversation. When you close accounts that are good accounts, that hurts you because now you're getting rid of that important history. But also, opening new accounts isn't the best idea either. They don't want to see new credit responsibilities popping up and you're in the middle of closing or in the middle of, the underwriting process. They don't want to see that. Please don't do it. The third one, y'all see it. I'm going to just take a pause while y'all read it, okay? Do not co-sign for nothing, for anyone, period. Don't do it. I know we love them. I know we may feel like they need us. It will kill your deal. Don't ignore your credit report. Even when you're already under contract, do not neglect monitoring your credit profile because things could change in the blink of an eye. And if you miss it and your lender see it first and you weren't transparent, that can cause trust issues. I don't want that for you. But also, don't rush the process. Preparation absolutely leads to long-term peace. Be patient but intentional. Do what you need to do, but don't rush it. I promise you, those keys are for you, and we're going to help you get them. Let's take our time. Check the boxes. Let's make sure we're not missing anything so that our lender, Miss Edie, can get you across the finish line. Now, take a picture, screenshot, scan the QR code. Let's pull your credit reports. Annualcreditreport.com will give you a free report for all 3 bureaus. Please pull them. Now, they won't include your score, but they do include all of the components of your credit profile that make up the score. Pull it today. Know where you stand. Well, Lyndsae, I don't plan to purchase for another 6 to 9 months. Guess what? Pull it anyway. Let's see what we may need to work on between now and then. Or let's just see how great of a position we are in already. Did everyone scan the QR code? Because I trust y'all to pull it.
Lyndsae, we can't see it.
You can't see the QR code?
No.
What
At
is
least
it?
I can't.
Uh-oh. What do you see, Adrian?
I see you. I see your pretty face.
So you haven't seen the screen the whole time?
Mm-mm.
Y'all don't tell me.
I see the QR code.
Okay.
Oh, okay, maybe it's just me then.
Oh, don't scare me
Okay,
like
sorry.
that, y'all. I'm like, wait,
Sorry.
it's okay. Listen, y'all with me? Y'all gonna get the real because things be happening live, okay? This is not going to be edited because it's great to see these human moments. So I know we gave y'all plenty of time to scan this QR code. Annualcreditreport.com. Okay? Now, protecting your purchase. I want you to think about the post settlement plan. Now that we've closed, have our home, there are some things I need you to remember. Budget for those utilities, maintenance, HOA fees if you have them. Make sure you have an emergency fund because things happen. Your hot water heater could go out in month 2. You could have sewer issues. Whatever it is, don't let these things scare you now because life happens and we know that. But you want to have the funds to take care of it. You don't want to have to get in too much debt to maintain your asset that we already have debt on. Does that mean that some of us might need to work on some of our saving habits? Most definitely. But you want to create an account for your home. If you don't have one today, I encourage you. Open up an account right now, this weekend, and nickname it New Home. And if you're starting the process, go ahead and start putting your money for your down payment, closing costs, reserves. And once you close, keep that account for your home emergencies. I want you to consider any type of home warranties to protect your appliances and things. My very first home that I purchased back in 2017, we still have home warranties on it. So whenever there's a problem, an appliance, a system, I pay that small service fee and have someone to come out. Because you want to take care of your assets. But you also want to look into proper insurances, insurance writers, and we have an amazing insurance professional that's going to talk to you about that because you want to protect that asset. And again, please, please avoid large new debts immediately post purchase, especially because usually your first mortgage payment, there's going to be a gap of time. So even you moving your home tomorrow, you might not have your first payment. What's tomorrow? The first. So usually you close in a month, your first payment might not be due until the month following the other one. We don't want you to go out here and make these huge purchases right after you close out of excitement and you're not even accustomed to your new budget yet. Pause. Let's get settled first. Let's move. Let's get comfortable. And then we can start adding other obligations that you can maintain. What is your home equity going to do for you? It's going to present a beautiful wealth opportunity. As you make your mortgage payments, you're going to increase the amount of equity that you have in that property. Lyndsae, what is the equity? So let's just take the value of your home. Let's just say we have a $300,000 home. Let's just say the mortgage on it right now is $200,000. That extra $1,000, that gap, that is your equity. It grows over time as you make mortgage payments and that mortgage decreases. As it appreciates, because we all want an asset that will appreciate over time, your equity grows. And now you can do things with it. You can get a home equity line of credit, home equity loan to make other investments, to buy another property, make a renovation to improve your current property, start a business, help your kids through school, whatever it is. Of course, as long as you're in compliance with the lender who has home equities. Now, a lot of lenders don't even have them anymore, but that option is still available. Sometimes with your equity, you can also refinance and potentially reduce your interest if interest rates have gone down since you've purchased. Or you can pull some cash out. Whatever option works for you. I have seen a number of people do a cash out refinance. Whatever works for you and your needs, but also for your budget. Because accessing that equity, that can potentially, if you don't refinance and take out cash, that HELOC or HELOAN, that's going to present a second payment. That's a second debt. It'll be a second lien position after your mortgage. You just want to make sure you can maintain it and take care of it. I don't want my kingdom homeowners over leveraged because we're building kingdoms, y'all. This is deeper than just buying a place to live. We're building equity. We're creating generational wealth. We are building our kingdoms, our enterprises. And I want you to take care of it. Take care of your investment. But again, I have some clients too who've pulled out equity from their home to go and purchase an income producing property. Now they're investors. You can do that with one home. The opportunities are endless. Open your mind to even the things that you might not have known were available to you. I told you you were in the right place. Now, a couple of resources and next steps for you so that we can get you all to our next few speakers. A couple of tools that I recommend. One, Experian, or you can use My FICO. You can get your pre-qualification, especially from our lender today at Wells Fargo. You'll get to meet your local housing authority for first-time home buyer programs. You can do them in person. You can do them online. Whatever fits your schedule. But get your certificate. Go through the programs. Learn. Get that education so you feel confident in your purchase. But also, most importantly on this slide, connect with me for one-on-one coaching. We offer free consultations or some of our group workshops like today. Even though you've come today, attend another and another if you choose. You can never have too much information. Remember, the financial decisions you make today set the foundation for the kind of homeowner and wealth builder you'll become tomorrow. Now, couple of quick things. Most people know me from finance, but as your realtor, I have a number of things to do for you in service of you. Your educator and advisor. And you're in great hands with me. I'm a homeowner, I'm an investor. And now, hopefully, you're a realtor. I'm your advocate, your negotiator. I'm going to go to bat for you for the best deal every time. I'm your connector. The Kingdom Wealth Connector, to be exact. My job is to connect you to the partners you need along the way, but also afterwards. I'm your built-in project manager. I'm going to help you handle those deadlines, documents, keeping your things organized. But I'm also your long-term partner. I'm here for the journey. Get comfortable with me. One thing that I offer my clients, any client that I help buy a home or sell one, you have a lifetime benefit of a free financial consultation every single year. Gotta use it though. Come see me. This is my contact information. Please take a picture, grab a screenshot, and let me know how I can support you. It was my honor and pleasure to deliver this information. And now I want to make sure that I can address any questions that you all may have for me. I'm going to check the chat. Team, keep me accountable to make sure I don't miss anyone. I'm checking the chat. Any questions? I know that was a lot of information. I know I had a few cough attacks in between, but let me know. How can I support you? And if you don't have any questions right now, you can leave them with us or you can email them to me. And we will absolutely make sure that we get you those responses. Next up, I'm so excited. We have one of my mentors, good friends, warriors, partners in the industry, Miss Edie Jenkins. She is a seasoned community mortgage consultant at Wells Fargo, proudly serving Baltimore, Maryland, and the surrounding areas. With a wealth of experience in the mortgage industry, she is dedicated to guiding clients through the home financing process with personalized support and innovative digital tools. Her commitment ensures that each client receives tailored solutions to meet their unique needs, making the journey to homeownership as seamless as possible. I introduce to you all Miss Edie Jenkins. Miss Edie, the floor is yours.
Thank you, Lyndsae. Good morning still? Yes. Good morning, everyone. As Lyndsae has stated, my name is Edie Jenkins. I have been in the mortgage industry for pretty much all my adult life. So I have seen the market go up and down. I have learned how to navigate through changes of interest rates. I've stayed in the mortgage business, so therefore I know what to do in order to get the job done. I'm going to begin today with, and I hope I'm sharing my screen, Lyndsae. Am I?
No, ma'am, not yet.
Okay. Let me do that. How about now? Am I good?
Not quite yet. So when you hit the green share button at the bottom,
Yeah.
it should pull up your list of everything that you have open already.
Let me cancel and do that again. Of course, it's not doing.
There we go. It's starting now. All right. Perfect. So you're sharing your screen. Now there we go. Awesome. Uh-oh. Now you've muted yourself. Let's unmute you again.
Okay. Got me?
Go. Yes.
Now let's see and you can see my screen?
Yes, ma'am.
All right. Thank you. And thank you for bearing with me, everyone. What I want to talk to you about today is the mortgage part. Lyndsae went through a thorough, in-depth process of what you'd have to do. But what I've noticed always when someone comes to me, it's a difference between being prepared and not prepared. And I, as a lender, I have no in between in working with you to get you to the point. If you're coming to me, then you are stating to me that, Edie, you are ready for home ownership, right? So if you're coming to me saying you're ready for home ownership and your credit is not good, then you're not ready for home ownership, unfortunately. I'm going to tell you what to do to prepare for me. So that's where we're going to start. This deck that you're seeing, and as I slide through it slowly, is just information that Wells Fargo has prepared for me. But I'm going to get into the intricate parts of what you'll need in between the lines. So when I'm going through this deck, I'm sliding through and I'm not touching on exactly what is a mortgage. What is a mortgage? A mortgage is a debt that you have on your home. The components of a mortgage. We're going to get into exactly what is needed as we move further. But what I'm going to do is, with this presentation, I can send this out to you so you can peruse and read thoroughly at your leisure. What I want to start with is the different types of mortgages that Wells Fargo, and guys, when I say Wells Fargo is a big bank. So you're going to get the same kind of information, the same products, no matter where you go. So you're being prepared for me, but you're also being prepared for the financial world. So it doesn't matter whether you go with Wells Fargo, Bank of America, Andrews Federal Credit Union. Any bank is going to use the same kind of guidelines. I'm just going to touch briefly on the different types of mortgages. We'll have the conventional mortgage, normal 3% down. At minimum, you can put as much as 20% down. You can put as much as any amount that you want, but as little as 3% down with a conventional loan. Your scores are 620 minimum. Right now, a conventional loan peaks at 766,550 with a 43 back ratio, and we'll talk about that back ratio more and further down in the presentation. In addition to that, you'll have your FHA loans. FHA requires 3.5% down. The difference between the conventional and FHA, you still have the 620. You have peak loan amount right now at 498,257. The biggest thing is you'll see on the debt to income ratio, you see where the conventional is 43. I can max out at 50 with comfortably, sometimes even going over with good compensating factors with FHA. So it's giving you a better ability if you're not quite, if you don't fit the normal guidelines. There's one more type of loan that I want to go over with you, and that's the VA. VA, anytime you have served in our military and have done the things that give back to our America, we as mortgage lenders have established a loan where you can put zero down, 100% financing for our veterans. Of course, that comes with documentation, but if you have served in the military properly and have good standing coming out, 9 times out of 10, you're going to be able to have 100% financing. Now you ask me, well, Edie, how do I qualify for a mortgage? The first thing that you have to do is come see me as far as getting a pre-approval. And this is what I'm going to talk about in depth about preparation. When you come see me for pre-approval, I'm going to ask you for documents, just like Lyndsae has stated, the things that you need in order to move forward. These are the things that, and we're going to go over it in more detail, but these are the things that are going to be needed in order to make it make sense with me. Now, again, if you're not ready, I'm also going to tell you that too. So moving forward, how do I qualify? I always reference the 5 C's in mortgages. And when I tell you I've been in the business for more than 20 years, more than 25 years, the 5 C's in mortgages has not changed since I was introduced to mortgages. And I'm going to tell you all 5, and then we're going to delve into the 3 that you have control over. The first one is your character. Lyndsae mentioned letters of explanation. They're vital, especially with first-time home buyers, because the underwriter, there's going to be so many hands on your loan file that people need to understand who you are. So the more that you talk to your loan officer, tell her who you are. If you've had gaps in your employment, those are the things that will look initially not so favorably on your credit package. But once you tell me why you've had gaps of employment, it makes sense. Character. You've had some dings in your credit, but maybe you've had a hard time. Maybe you've been ill and you haven't been able to pay in a timely fashion. Those are character. Those are your letters of explanation. They're vital to making your loan look human now and not just black and white numbers. The next thing is collateral, which Lyndsae has to deal with, not me. Only thing that I have to do with the collateral is make sure that it's worth the value that you're putting into it. But that collateral is your home, because that's what we're going to base our loan off of. The next is capacity. How much can you afford? By your income, by the credit that you have, how much debt do you have? The debt to income, you're going to hear me speak about that a lot. Your debt to income ratio. That's how you determine how much capacity of a mortgage you can afford. Credit. Credit is vital. Credit will get you in the door to talk to me. If you're not prepared with your credit, I won't even see your application, because anything lower than a 620, I don't even see anymore. So it is vital that you have your credit up to date and current and looking good. The lastly is capital or cash. How much money do you have to put into this purchase? Lyndsae has talked about, not only do you have to have your down payment, but you have to have living expenses. You're going to have to live after the mortgage, after you close on your home and you're all happy. Well, I don't want to debt you out. That's hence the reason why we don't go over 50% of your income. Well, you say, well, Edie, I pay 65, 70% of debt to income for my rental. But you can't live. I want you to be able not only to live, but live comfortably. I'm not including insurance. I'm not including taxes. I'm not including the basic food, the things that you need to live on. So when we talk about 50% of your income, that's a lot to be putting on your mortgage and continuing to live comfortably. Does that make sense? And I can't see, Lyndsae, if I have any questions. So please help me there. The thing that the 3 C's that I'm going to talk to you about today again is the 3 C's that you have control over. Your credit, your capacity of how much you can purchase, and your cash flow. Let's talk about credit first. Now, you see the realm of credit. This is a game, guys. And if I'm talking to my community, we have not been in this game very long. And I want to say, equal rights, we were able to vote in 1967? That's about how long we've been fair about being in this lending game. Before, the lenders had their ability to say, I'm going to either charge you exorbitant amount of interest, or I'm not going to let you play at all. We have just been in this game for maybe 70 years, which is nothing compared to the 400 years we've been in this America. So what I'm saying this for is I want you to give yourself grace. Give yourself the ability to fall and stand up and fall and stand up, because this is all new to us. But you have to play the game if you want a mortgage. So what does that mean? I need you to, just like Lyndsae said, pull your credit report. It is imperative that you know what's going on in your world, because your credit score, your credit report is you until I find out more about your character, more about who you are. If I'm just looking at the basis financial, we look at the credit report first. Like I said, I don't even see your mortgage if it's in the orange. If you're in that 580, I want you. Our bare minimum is 620, but I really want you to be in the yellow. I really want you to be ready for me. Being in that yellow gives you the opportunity not only to be pre-approved and to move forward with the mortgage process, it gives you a little better interest rate. Because of course, the higher the interest rate, the higher your score, the lower your interest rate. So you really, in this credit world, you really want to be prepared. So what does that score encompass? Timely payments? I don't care. Okay, you owe $1,000 on your credit card, and they're asking for $20. Put it on automatic pay, the minimum balance. If you want to pay more, great. But the engine of this credit machine will see that Edie pays in a timely fashion every month that $20. That's huge. The next thing is your total amount owed. So if I know that I have a $5,000 outstanding or high balance on my credit card, that machine is looking at that 5,000 and saying, is she at the max of that 5,000? Because if she's at the max, that means she's in trouble. That means if she needs money, she's going to be over. And she's not going to be able to pay me back or pay the lender back. So that $5,000 high balance looks good if you can keep your outstanding debt, best case, 50%. Not so bad, 60%. What do I mean? If you have a $5,000 high balance and you're maxed out at 2,500 right now, you look good. That means that you know how to handle your debt. You're paying in a timely fashion because that $2,500 outstanding that you've already used probably has $100 a month payment. You've already got that $100 on auto pay, so you're paying in a timely fashion. You're at 50% of that capacity. You look good. That machine, because it is a machine. You hear me say that. Nobody real is looking at it. So they have components in to say whether you're a good candidate or not. One of the big candidates is not maxing out your credit. Timely payments are crucial. Maxing out is definitely a look at. When you have judgments, it's okay. Things happen. Just address. You don't want to leave anything shoved under the rug, because they're shoved under the rug in your mind, but not on your credit score, not on your credit. Everything is looked at. You have to address everything. And I want those judgments, even if they're there. If you have a judgment and you've already accounted for it, and you have and you're making monthly payments, we can still move forward. Those judgments that have not been accounted for, that's the problem. Now, when I say you're making monthly payments, guess what? That's going to be a part of your debt to income ratio, because that is now a debt. So be careful of that. Okay? Bankruptcy, wait until it's over, because we want to remember, this is the highest thing that you're ever going to have as far as debt is concerned. Your mortgage is going to be the most expensive debt that you'll gather. So if you have a bankruptcy on your credit that is new within the past 7 years, the likelihood of us being able to move forward with you is I would say not high, maybe 10%. Lastly, the number of times potential lenders have reviewed your credit. Now, I would say that's not a big deal anymore, because lenders have gone, especially Wells Fargo, we have gone to what we call a soft credit pull, meaning that it will not affect your credit at all. You will not see it on your credit score or your credit report coming up as an inquiry. It's a soft pull. Now, if you said, Edie, this is after you've made application and we've talked, this is something that I want to move forward with. I like Wells Fargo. I like Edie. I want to move forward. Then I will pull a hard credit pull, because you're staying with me. And that will move forward, and it will show up as an inquiry, but not until. Does anyone have any questions in reference to your credit? Well, let's talk about, do we have, did we have any questions?
None yet. We're good to go.
Okay, thank you. Let's talk about, and you can still see my screen, correct? Because I just made it a little smaller.
Yes, ma'am.
Let's talk about how you qualify when you come to see me for a mortgage. Again, this is not magic. The lender cannot fool you and say this, you don't qualify because of this, or because you don't owe enough, I'm going to base my qualifications on the same rules that I based it on in 1983. And that's how much money on a monthly basis you have to go towards your mortgage payment. okay, and the rest of your debt. So the credit report, vital, right? I'm going to use now remember, I'm giving you this information because I want you to be able to do it for yourself. Any monthly debt that you have, let's say you have a car payment of $500, and your credit cards add up to $200. And then you have a student loan, which put a pin in that because I want to talk about the student loans in a little bit more depth as well. But all of that equals $800. That's $800 that I'm using on that 50% debt to income ratio. So I'm just going to I hope you have your pen and paper out because we're just going to do a play debt to income ratio qualifying for Edie. Let's say you make $100,000. And unfortunately, guys, you guys are living in a time where everything costs so much. So we have to make sure that you find a place that is comfortable for your living expenses. So if you make $100,000 a year divided by 12, because remember I said we work in months, that's $333 a month. If I'm saying that my max debt to income ratio is 50%, right? I'm going to say times 50%. So your ability to qualify for a mortgage cannot exceed $4,166. That is 50% of your $100,000 a year, $333 a month. 50% of that is 4,166. But remember, I said you have $800 in debt. I'm going to take that out. Your mortgage payment now, what you can afford in a mortgage per month is $3,300. I'm just rounding it up. $3,300 can get you a lot of house. But what goes into that $3,300? Because remember, when I do calculate my total mortgage payment, I just don't have principal and interest. And that's the reason why I don't, we'll talk about that more, is because I want to make sure that you keep the house. So what else is included that you have to have? You have to have in your every year for your house. If you're a homeowner, you have to pay taxes on the house. Now, suppose you don't have, I didn't include it in your monthly payment, and you don't have money to pay your taxes at the end of the year. You lose your home, and the mortgage company loses their asset, the thing that they have used to qualify you for the house. To ensure that doesn't happen, your real estate taxes are included in your monthly payment. Okay? So now we've got your principal and interest, the way you're paying me back on that loan, plus your taxes. And there's one more thing that goes into that mortgage payment that has to be done, and that's insurance, homeowners insurance. Why, Edie? I can pay that. That's not going to be a lot. Well, again, suppose you didn't have homeowners insurance, or something happened to the house and you used it to the point where now they're coming back and saying you were paying $1,000 a year. Now you have to pay $1,500. Well, again, the lender has to make sure that their asset is covered. So the homeowner's insurance is crucial. So now there's 4 things that are in that mortgage payment that I have to account for in order to qualify you. Your principal and interest, we already know. Principal, interest is how much you're going to pay me back on. Your taxes, you have to have your real estate taxes in order for me to feel comfortable that because I'm going to pay it myself. So, or the lender, when I say I'm the lender's going to pay your yearly taxes themselves to ensure that they are paid because you are paying me per month in order to have the money to pay on a yearly basis. Same as your homeowner's insurance. So that's 4 components that need to be into your homeowner's, your total mortgage payment. Does that make sense? So when I say that you have $3,366 for your mortgage, that's how much you're going to be paying me back. Well, guess what? That does not mean that that's what your mortgage is based off of, because I'm going to take out 150 minus $150 for your homeowner's insurance, and then another 400, say, and this is all estimates, for your taxes. So now I'm basing your mortgage payment off of 2,800, not that 3,300. Tell me if I've lost anyone. Tell me, make me say this again if I need to. Good. Total mortgage payment includes taxes and insurance, principal and interest. It's called PITI. Okay. So in that, I have made that 1 and 2 all my conversation. So the total debt in number 2 is that 50%. That 50% of your monthly income minus any monthly debt that you have on your credit report equals what the leftover is what your mortgage payment can be. Okay. So I want to make sure that everybody understands that when you come into me, okay, so the last component of that, well, you said, well, Edie, you said $2,800 goes into my monthly payment. As Lyndsae said, there's a lot of loan mortgage calculators out here. And that's so good because when I started, I'd have to calculate backwards in order to find out how much that $2,800 computes to. But I'm just going to give you, I'm going to say that, let's say 300 on a $300,000 house, what the principal and interest would be. 30 years. And that's one thing that I want to talk about. I automatically do 30 years because there's no prepayment penalty. I want to get you into the most house that you can get into for the longest debt. It's okay because there's no prepayment penalty. If you say, well, you know what, I want to pay this thing off in 20 years, there's amortization schedules that can show you how to pay off quicker. But I would rather have you in and comfortable with that 30-year. So a 30-year payment right now, the interest rate, let's say this interest rate is at 6.875 right now. I know, don't kill me because interest rates are not pretty. But that gives me a $1,900 mortgage payment. And that is, what did I say, 222, so that you could go up a little bit further. So you would be comfortable at $300,000 with depending on your debt at the scenario that we just went over at $100,000 with $800 worth of debt and total mortgage payment. So you can feel comfortable at 325. So those are the kind of things, again, I want you to play with. If you know how much you can afford, then you can plug in to your mortgage calculator how much you will qualify. That's if you want to do it prior to seeing me. If when you come to see me, I'm going to max you out. I'm going to tell you, put in an amount that you're wishing for. If I can push it higher, I will, because I'm going to push it to that 50% max. If I can't, then we'll talk about what we can do in order to get you there, depending on your credit, what outstanding balances you have, how much cash you have to put into the deal. Those are the kind of things that we're going to look at. Now, the last C that you have control over is savings. Savings for your down payment. Now, I can't stress upon you more that these three items, your credit, how much you can pay, and with the how much you can pay, it's going to be based on your income and your debt. So we're going to figure that out. So that's not going to put you out. It might not find you the house that you want for your first home, but that's okay because it'll be your starter home. It's not the end, it's the beginning. The last thing is that will put you out is your ability to have money for your down payment and closing costs. Guys, that is so crucial. So when you're working on your budget, Lyndsae talked about having a budget, being prepared. Right now, you guys, and I say you guys because I'm speaking to the demographic of now. You're the working person out here trying to make it in this economy right now. It is incredibly hard to save right now. But you must do what you have to do if you want your own home. And I promise you, a person told me when I purchased my first home, push as hard as you can because it will pay off. I saved for 5 years in order to get my home on my own. Then, because I had a home before I got married, when my husband and I merged our debt and we wanted to buy a house together, he had a house, a little townhouse. I had a little townhouse. I don't know how this happened, but I sold mine. He retained his, which we still have today. I used mine for the down payment for our step up. When Lyndsae said this is riches, it works. We were able to get more house because we had the ability to have savings from the equity in my house. Now, did I pull the short straw and me losing the house? I don't know, but it worked out really well because we were able to be investors because we saved his house. We were able on my side to have money to put down on a new house. And we were able to have a family home. And that was not our last home. But that's how we initially came in and were able to grow because of the fact that we were homeowners. So you can get your that going back to that savings ability. I know it sounds daunting, but it can be done. So what I'd like you to do is do the 50, 30, 20. That 50% is your debt and all your living expenses. 30% is the worldly stuff. You got to eat. You got to pay your insurance. You got to go to dinner sometimes. And a cocktail now costs $20, which is killing me. And it's probably much more than that, but it's everything it costs. So that 30% is your living. 20%. Try to do 20% of your monthly to go to savings. So you'll have the ability to put the 3%. Remember, on a conventional loan, you need at least 3% down. You also need at least 5% in closing costs. So when I talk to my new customers, my first time home buyers, I just put in their mind to think about, on a, let's say, the $300,000 loan that or a home that you want to buy. 8% of it is already going to go to closing costs and down payment automatically. So what does that look like? On a $300,000 house, if you didn't get any help from any lenders or any of the community down payment assistance programs, you would have to come up with $24,000 at bare minimum. Think about it. That's why I need you to be prepared. The three things that you have control over is your credit. I want your credit score to be as high as it can be. I'll figure out, and we'll figure out the capacity of how much mortgage you can afford depending on your income and debt. But your savings is back in your ballpark. It's going to cost to do this. Now, to close on this, Edie, how in the devil should I come up with $24,000? Well, it can be done in a number of ways. You can get a gift, and if you're able to get a gift from a family member, then they can give you the whole amount. We just have to show that they have the ability to do so. So we're going to ask things from them. You can get grants from me. I have a $10,000 first-time homebuyer grant that is available to first-time homebuyers in a segmented area, meaning that I want to make sure that you're bettering yourself. So if you're going from an area that has not been gentrified, if you will, and it's on my segmented property list, I can give you the $10,000. That $10,000 is a give. We're going to give you a 1099 at the end of the year. There's no debt on that. That's I'm not going to say free money because you are paying taxes on it, but that is money to help you into your home. So that $24,000 is now 14, makes it feel a lot more obtainable. In addition to that, we have another, depending on your income. So that $10,000 was where you're buying or where you're coming from. The $5,000 is based on income. If you're under the median income, and I think the median income in this area is $120,000, I have another $5,000 that I can give to you. So now that $24,000 is, I'm giving you $10,000 towards the property, where the property is located. I'm giving you another $5,000. So now you are really looking like you can do this. But I need you to start your savings ability. If you're going to go out and spend $200 in a weekend, spend $100. Put $100 away. It adds up, guys. Another way that you can pull, I can use your your spent 401k. That's what or thrift savings plan, whatever your company has for you. We can do, and without penalty, you should be able to pull from your 401k. And that's another way that will help you get into your home. So in summation, I've said it, I know, 50 times today. The 3 C's that you have control over. The biggest one, your credit. Because if your credit is not good, I won't even see. No lender. We don't see it. If it falls under 620, they send you out a letter saying, you want to help work on that. The next thing, how much you can afford depending on your debt to income ratio. Remember, if you have the reason why Lyndsae put so much emphasis on pulling your credit report, because you don't want to have me tell you how much debt you have and what you need to do. It's too late, because I'm going to tell you, well, if you want to be here, then you have to come back. You have to pay down that Amex. You have to get rid of that Macy's. You missed a payment in December of 2024. How crazy is that? Those are the things that you can look at, find out, make your necessary repairs. I'm not saying that you will not be able to get the mortgage, but you must be able to identify what needs to be worked on and have that credit score as high as possible. Remember, I told you this, don't fault yourself for having a low credit score, because like I said, this game is new to us. We didn't know that we were not supposed to debt ourselves up and be maxed out. All I'm saying is you must have the ability for repair, and repair sometimes takes time. So if you're not ready for me yet, I told you this is a 30-year mortgage. If it takes you a year, 2 years to be prepared for me, that's nothing. It's all in what you want to do. Credit, we talked about that. Capacity, we know about that. In all of what you do, getting your credit ready, you're making your income, you're paying down debt so you can afford more house so that your capacity will be better. Lastly, you're saving your money. I don't care what vehicle that you use to save your money, please do so. And that is the end of my presentation.
Woot, 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 woot. Amazing job, Miss Edie. Thank you, thank you. And we have a question in the chat. So, to confirm, we need to
Yes.
be prepared for 8% in closing costs, which is separate from the 20% down payment.
Oh, good. That's an excellent question. No, that's a major question. That 20%, that you don't have to have 20% into the deal. What that 8% is, that's 3% down. 3% down for your mortgage. That's the minimum that you can have for your down payment. Okay. And then 5% is what the closing costs and the due diligence of getting your mortgage filed with the county and the state. That's a 5% closing cost. That's paying everybody that you're going to have to pay for your appraisal. You're going to have to pay to do all the necessities that are required in purchasing your home. So that's 5%, and that's not going anywhere. But all you need for your down payment, not 20%, but 3%. Now, if you give me just a little bit more leeway, Lyndsae, I want to also state, because of that 20% requirement, anything over 20%, remember I told you that magical total mortgage payment would be taxes and insurance and principal and interest? Well, there's one more insurance that's added in there if you don't have 20% down, and that's mortgage insurance. That's the insurance that the lender gets from an investor that says, guess what? If Edie doesn't pay on her mortgage, I want you to guarantee me that I'll be paid off. That's that 20% insurance. So they pay the first 20% of the outstanding mortgage, and then the rest should be covered in the value. So that is another part of that total mortgage payment that would be financed in your monthly payment. Does that answer the question, I'm hoping?
And India, please feel free to. Oh, she said yes. Amazing. And India, I hope that I am pronouncing it correctly. It looks almost like I'm assuming I'm pronouncing it. But Miss Edie, her follow up to that was, can you also elaborate just a little bit further regarding penalties for paying back early?
Oh, and there is none. And guess what? There used to be. There used to be prepayment penalties. They no longer can, because that's kind of against the law. That they were tacking on 5-10% of the outstanding mortgage if you paid it off early. How crazy is that? No, there's no prepayment penalty. We want you to be able to pay us back earlier, because guess what? The faster you pay off, the more equity that's in your home that you can do other things with. You can grow and have ready money. And just like Lyndsae said, once you get into this home ownership game, it's no turning back. I've told you my scenario, which to me was magical. I didn't even know that things could happen like that. But equity in your home just introduces a world of other things that other people have been taking advantage of for a very long time. So we want to make sure that we get the opportunity to do so as well.
Thank you so much for your questions. Thank you so much, Miss Edie. This was absolutely amazing. And we know
I,
sometimes talking to, our partners in the financial industry can sometimes be a little scary. So thank you for making this such a safe and comfortable space. India, thank you for your questions. Do we have any additional outstanding questions for Miss Edie about the mortgage process, about preparation, anything that you heard today?
and I just want to state as well and say it's a lot that goes into a mortgage. It's a lot that I talked about today. Please, please don't be afraid. You have Lyndsae, you have me. Let me just say, I have been in the business for a very long time, and people use me. And I don't mind being used, but I would rather be used by people that look like me. Call me. I can tell you what's good and what's bad. I would rather talk to you before you make an application and say no, or just make sure that you're comfortable. If you have a question, if you think something's right, but you're not sure, call me. Yes, this is my business, but I've been in the business so long because I really, really enjoy and love doing what I do. I have helped my demographic now, weirdly, is 25 to 35 because they trust me. I'm going to make sure I'm not always going to tell you what you want to hear, but I'm going to tell you what you need to know. So my number is on the screen. Please feel free to reach out to me at any time.
Thank you so much, Miss Edie. And I am going to put all of our incredible speakers' contact information in the chat. So please, please, please do not worry. And if you are here live on YouTube, or if you joined our Zoom and you did not actually register via Eventbrite and we don't have your email address, I encourage you to drop your email address in the chat, send it to me, share it with us on YouTube so that I can grab it, and make sure that you can have everything that you need. We will send out slide decks, contact information, as well as follow-ups. Okay, so please make sure that we capture that information. And last but most certainly not least, I am going to introduce our third and final speaker for this day's workshop. And listen, I know that we're a little close to time, but please make sure that we give Adrian our time, our energy, and our enthusiasm as well. Ms. Harris is a licensed insurance professional dedicated to helping millennials secure their financial futures with clarity and confidence. With a passion for demystifying life insurance and wealth building strategies, Adrian tailors personalized financial solutions that protect income, grow wealth, and create lasting legacies. She specializes in guiding professionals towards financial independence through index universal life insurance and tax efficient planning. Her mission is to make financial security accessible, relatable, and empowering for a generation ready to protect their families and build the freedom they deserve. Now, even if you are not a millennial, guess what? You are still safe here. Adrian still wants to support you. So I introduce to you all Miss Adrian Harris.
Thank you so much for that introduction, Lyndsae. That was amazing. And I know we are close to the 12 o'clock end time, so I promise not to take us too long over the end of the time that we allotted for this today. So really quick, I'm going to share my screen and talk to you guys a little bit about my bulletproof framework. And so to give a little more information about myself, my name's Adrian. I'm originally from Charlotte, North Carolina, and I currently live in Washington, D.C. I graduated from Tennessee State University, so I'm an HBCU graduate like Lyndsae, and I'm a licensed insurance broker since 2022. And so the unique position that I'm in is that instead of working for one company, I actually represent the entire industry. And so I work with some top companies, including Transamerica, Nationwide, Fidelity, North American, Pacific Life, Mutual of Omaha, just to name a few. And so, with that being said, I have an intimate understanding of the struggles that we as Black professionals face when it comes to building and sustaining wealth. And I think that this has been a key theme throughout today's workshop is wealth, right? How do we create it? How do we build it? How do we pass it along? And oftentimes, a lot of us are juggling debt, right? We're juggling investments into our own personal ventures and businesses, and then sometimes even repairing generational gaps in educating and gaps in not only finances, but education. And so it's easy, very easy to prioritize what's urgent over what's important. But I also know that the kind of wealth that lasts is built by making intentional long-term moves today that our future selves and our future families will thank us for tomorrow. And so what I want you guys to leave here today with is an understanding of what a solid protection plan looks like. Maybe get some insight into a defined strategy on how to create a tax-exempt income stream for yourselves in the future. And most importantly, a clear understanding of your financial goals and the most efficient ways to achieve those goals. And so my framework, I call it the Bulletproof Roadmap, is based on a few different things. First is proper protection. And so we've talked about different forms of insurance, but I think that that is super foundational in building wealth. I know, Lyndsae and Miss Edie both talked about, okay, you want to get the house, right? But what happens if you fall ill? What happens if you're unable to work, right? Do you work so hard to get a house just to let it slip away in the face of the unexpected? So we want to protect that decision. Managing your debt. creating an emergency fund and building up that emergency fund. And then we're getting into how to accumulate cash in a way that's tax advantaged. And then finally, it's legacy and estate planning, right? So once you get the house, how do you keep it in the family? What does a trust look like? What do wills look like? All of that. So full comprehensive planning to make sure, again, the wealth that you're creating is protected. So let's look at some stats. So Black Americans are more likely to see life insurance as a planning tool, right? So we understand it, but only 56% are covered compared to 70% of some other households. And so that is a problem, right? We know it's important, but somehow don't feel compelled to action. And so there's a few problems that I solve with the people that I work with. Problem number one is more than 50% of people overestimate the cost of life insurance by 3 times or more, right? So before you even really look into it, you're like, hey, I can't afford it, which is a mistake. Problem number two is over 100 million Americans are either uninsured or underinsured when it comes to life insurance. Problem number three is no source of truth regarding reputable companies or what is the appropriate amount of coverage, right? It can definitely feel like people just want to sign you up for something, sell you something without knowing, okay, what does this do? How far will this take me? Problem number four is people, of course, you want to safeguard against a diagnosis or a medical emergency that would devastate your finances or ruin your ability to earn income. Problem number five is, okay, how do you avoid creating an account that has a massive IRS debt as you continue to grow, right? As these investment accounts grow, your tax liability continues to grow. And then finally, problem number six, maybe you're like, hey, I want to save money. I want it to grow, but I'm not sure where that is. I don't want to lose money. I don't want to watch the stock market every day. My job keeps me busy enough. I don't want a second job in managing my money. So how can I do that? And so we have some case studies here that I want to review with you guys very quickly. So we're talking about protecting income. So that is one of the first and most basic functions of life insurance. So we'll look at Monica. So Monica, she thought that she would never need life insurance, right? At least not while she was still alive. So at 35, she was healthy and focused on growing her event planning business. But when she learned that she could secure a 30-year term life policy for under $29 a month, she decided that it was smart, right? It's a no-brainer. Like Miss Edie said, that's the cost of a cocktail, one. And so with $300,000 in coverage, she knew that she could access living benefits if she ever faced a serious illness or an injury. And it was a just-in-case policy, right? A backup plan that she never even thought that she would use. But then 7 years later, the unexpected happened. A car accident left her with a back injury, and she was not able to work or run her business the way she was before. And so, she's kind of recovering from that. And then 3 years later, something else happened, right? She got diagnosed with a chronic illness. And a chronic illness could be like heart attack, stroke, things like that. And so her medical bills piled up because, as you know, health insurance does not cover everything. And the stress of keeping up with her mortgage payments while managing her health really hurt. And that's when she read that this policy with benefits. So unlike regular life insurance, traditional life insurance, it allowed her to actually accelerate her death benefit while she was alive. So over those 7 years, she paid about $3,000, $3,500 in premiums, and she was able to access $13,000 in cash. Money that helped her cover her mortgage, medical expenses, and everyday necessities while she focused on recovery. And so Monica often wondered what would happen if she hadn't bought that policy for $29 a month years ago. And without it, she could have lost her home, her financial stability, and maybe even lost the ability to care for herself. But instead, she had a little breathing room and had a chance to recover without drowning in debt. So when I mentioned protection, those are the types of things that we want, right? We want to get the house. We want to get the furniture, right? But also we want to protect the decisions that we've made. And then we'll look at another example. This one is more of a policy that actually accumulates cash value. So we'll look at Jasmine. She's 30 years old and she's a healthcare administrator. So in her policy, she's putting in $250 a month into a permanent life insurance policy, meaning it doesn't expire, and the face amount is $250,000. So in making this decision, she had a few goals. To one, protect her son if something happened to her, build a tax-free retirement income stream, avoid stock market risk and grow your money more safely, and then also leave behind a financial legacy, right? Because it doesn't expire. So that means when you pass down your house, when you pass away, right, you're also passing down a life insurance policy or the proceeds from it, which could allow your family to, pay any taxes that they need, renovate it, so that way it stays in the family and continues to be an income producing asset. And so her overview is she was contributing $250 a month, which is $3,000 a year, into an index universal life insurance policy. Now, how this type of policy works is that the cash value inside is linked to a stock market index. In this example, the S&P 500, which is the 500 largest companies in the United States. In this policy, there's a 0% floor. So what that means is when the market is down, right, like it has been the past few months, you don't have to worry about losing any of your money. And then when the market is up, you get the gains up into a cap, which depending on the company can be between 9% or uncapped. And so she funded this for 30 years. So between age 30 to age 60. And the average rate of return in this example was about 6%. So what does that mean, right? So that means over the course of 30 years, she put $90,000 into this policy. And so the cash value accumulated to about $150,000. What that means on the back end is that it's able to pay her $12,000 a year for 20 years tax-free. So she put in $90,000. She took out $12,000 a year for 20 years, which is about $240,000. And then by the time she passes away at 85, there's still a death benefit of $275,000. And so the contribution is literally tripled, right? 4x, because she puts the money in, takes out over twice as much as what she put in, and still leaves generational wealth. And so what did she gain? One, immediately from day one, $250,000 in life insurance protection, which is immediate peace of mind for her child in the event of something happening to her. And she locked in her premiums while she was young and healthy. She got tax-free retirement income, so access to $12,000 a year for 20 years. So there was no taxes, no penalties, no income limits associated with this product. Her growth was protected. So her cash value never dropped during down years, and she was able to enjoy compounding interest on the gains without the risk. Flexible living benefits. So again, while you're alive, if something happens to you, you can access the fund while you're alive. And then finally, there is legacy preservation. So even after withdrawing the money, she still had a very significant tax-free death benefit to pass on. And so when we talk about building wealth via life insurance, there's a few desired realities. The first one is income replacement and family protection. So the goal, again, is to make sure that your family isn't struggling should you pass away, or to make sure that your asset that you have in your family stays in your family. Like for me, I don't have any children yet, right? But I have a condo. And so, okay, if I pass away, my family, it can go to my mom, it can go to my little brother. That's the asset that they have that will be paid off because my life insurance can pay off my mortgage. Debt coverage and final expenses. So again, saving your family from financial stress by covering funeral costs, medical bills, and outstanding debts that I would leave behind. Legacy building and generational wealth transfer. So creating a tax-free lump sum that can fund education, support heirs, help them buy their houses and start businesses, and serve as an inheritance, especially important in closing the racial wealth gap. Right? We shouldn't be getting it out of the mud generation after generation after generation. And then finally, wealth accumulation and living benefits, with the goal of using the cash value component as a financial asset. So similar to the equity in your home, The cash value in the life insurance policy, you can borrow against it, you can withdraw it, you can use it for future needs like real estate, emergencies, and retirement income. So who is this for? Right? It's really for everybody, but specifically, I like to say mid-career professionals. So people ages maybe late 20s to 50. And so the goals are usually income protection, debt coverage, and building wealth in early retirement. It's for business owners. Business owners can use it for business continuity, to protect debt, and to cover key employees. And so it can also be used as collateral for business loans or lines of credit. It protects against the sudden loss of a business partner or a very important employee, right? So imagine you have a business and your partner passes away or can no longer contribute to the business. Where does that leave your business, right? So it's protecting their contribution. And it can also be used for executive bonus plans, key person policies, things like that. Parents, of course, that's the obvious one. Protect your kids' future, pay for their college, replace your income if something were to happen to you. So it's a very inexpensive way to just secure your children's financial stability. If you're married, it can ensure that the surviving spouse and kids can pay off the mortgage. They, have some cushion to recover from losing you. And then you can always convert it later to permanent coverage. And then finally, there's grandparents, right? So grandparents are usually past the point of starting businesses and, all of that, but it's literally the easiest way to leave a legacy and help with your grandkids' future, right? So maybe a grandparent couldn't pay for college, but they can get a life insurance policy that can pay off the student loans, right? There's so many ways to create wealth. And to me, life insurance is the easiest shortcut to be able to do that. And so here's an analysis, which I think I'm going to skip this slide. But so really there are two mindsets that we're dealing with, right? And so I think this word has come up in everybody's presentation today, the investor, right? Investors are driven by responsibility and future planning. They want to protect the people that they love. They want to cover debt. They want to ensure that their legacy continues. They're driven by life events, marriage, children, buying a home, starting a business, or even witnessing a death. And then financial literacy. They understand risk management and view life insurance as a tool and not an expense. So it's all about that mindset shift. So the progression is, what happens to my family if something happens to me? Or I want peace of mind, and then let me explore my options and get covered. And the outcome is obviously purchasing a policy that makes sense for you. And then instantly you have that long-term peace of mind and financial security. Or you can follow path 2, which is the resistor, which is driven by procrastination or denial, right? And it's so easy for us to say, I got time, right? Nothing will happen. Or they view it as expensive, unnecessary, or they just don't really understand how life insurance works. And so that mindset is, I don't need it. I'll do it later. I just don't even feel like being bothered with it. And so that outcome is you remain uninsured or underinsured, and possibly, hopefully not, right, may face regret or financial hardship in the future, especially if a crisis occurs and you are not prepared for it. So with that being said, if you see yourself in this first path, right, path 1 of the investor, what I will do is drop my link in the chat. And it's just for a 15-minute introduction call with me one-on-one. So that way we can kind of talk. I can learn a little bit more about your mindset, your goals, and, continue the conversation if you feel like it's something that you want to add, if you're ready to add on in your wealth building journey here. So thank you all for listening and for tuning in. And I hope that this information was valuable and got you thinking.
Thank you so much, Adrian. This was absolutely phenomenal. And one thing about doing business with the kingdom is that we're having conversations that most people don't want to, right? That most people are uncomfortable with. So this conversation was absolutely timely, and you don't see it often in home buying workshops because a lot of times they just want to get you in the house, but how do we keep it, right? How do we truly preserve it? How do we make sure that if something happens to us, year 10 of that 30-year mortgage, that our families can inherit that property clean and clear? So thank you so much for this information. We want to make sure that we open the floor to Adrian for any questions that you might have about insuring your home or estate planning and all the things. Let me check my private DMs. So, Adrian, I have one question for you. Let me see. And Adrian just dropped her link. But one question that we have, Adrian, when do you recommend home buyers start that conversation with you about protecting that home? Is this something that you want to talk to them about pre-purchase, or once they actually own it, you know, the title is good, etc.?
I would say from my perspective, like the sooner the better, just because time is always ticking, right? And so it's cheaper to get it while you're young, but before something happens, much before something happens. Like Miss Edie shared, right? She saved for her down payment for 5 years. And so 5 years is a long time, right? If you get sick in 5 years, now your down payment money has to go to other things, right? So really it's protecting what you already have. It's protecting your savings. It's protecting your liquid assets in your home, so that way your plans can stay in place. And so to me, time is of the essence, and the earlier or the quicker you can just get something in place, the more advantageous it is for you.
That's good. Thank you so much. And as we prepare to close out, and thank you all so much who are here still with us right here in Zoom, as well as live streaming on YouTube. We appreciate your time and your patience with us. Please feel free to drop any questions in the chat for any of our speakers now. We want to make sure that we leave no question unanswered. No question is too small or too large for any of us here. Ladies, while we're allowing our audience a couple of moments to bring up any remaining questions, do you have any, just kind of a 30-second word of advice for people who are embarking on the home ownership journey and may be a little nervous or a little unsure, or they may be the first ones in their families? What would you tell them?
Pray about it. Pray about it. Do it. Do not sit on the edge and watch everybody else's life go by
Mm,
doing the things that you want to do, because it can be done.
that's good. That's good. Adrian?
Um, I would probably say find somebody to talk to that can lay out the steps for you and stick to it, right? Like I feel like it can just be so confusing. And I don't know, I feel like there's a lot of stigma around like, oh, it's so hard buying a house, right? And not to say that there aren't challenges, but you may be anticipating challenges that do not even apply to you. So the quicker you can speak with somebody and really get some personalized advice to know what you're up against, it can be so much easier. I know, buying a house is this big thing that was on a pedestal. And when I was ready to purchase, I maybe had like a 6-month timeline. And I was actually, I talked to a realtor and I was just like, oh, like, okay, I can do this. I can do this. I can
I'm
do this.
ready.
And luckily COVID happened. So it was easy for me to save money. I was in the house not doing nothing for 4 months. So that helped me greatly. But yeah, it was definitely it became tangible when I sat down and spoke to a professional that could guide me through the journey.
Adrian, that is a huge point, because guess what? A lot of you are ready. You just don't even know it. So you're right. If you look into the components of what it takes to get a mortgage, you guys are smart. You're educated. You know a lot more than the average bear. So that was a huge, huge statement right there.
Thank you both. Very, very, very powerful. And the only thing I will add to that is secure your winning wealth team. You cannot do it
Mm.
alone. We do not want you to do it alone. That is exactly why we're here. And if you are, accustomed to doing work with me, then I'm very intentional about who we bring to the table, because you got to have financial partners that you can trust. You got to have partners that you can build real relationships with and not just transaction ships, because it's different, right? Put together your team. You already have three of us right here. There are only just a small few people that we might be missing from this group, right? Like a CPA, having your accountant, or having that personal banker, right? That personal banker is going to collaborate with your mortgage consultant, right? We really want to make sure that you have a team behind you as we walk to this closing table to secure your keys. Don't do it alone. Even if you feel like you have had to do everything alone before, or you were always charting the course as the first one, guess what? That time comes to an end. We are here for you. We want to support you. We want to be at the closing table with you. We want to be at the
Celebrate.
the housewarming if you invite us. If we graduate from being a part of your team to a friend, we want to be there. But most importantly, we want to just make sure that you're getting the education and the resources, because when you have education, you can then use that to make very intentional and strategic decisions. This was absolutely amazing. I don't see any additional questions in the chat. So that means, ladies, we did our thing today. Really, really amazing information. Thank you both for your teamwork, for your collaboration. It is always collaboration over competition in anything that I do, in anything that I touch. So if this was your first experience with the Kingdom Wealth Connector, I definitely hope that you come back. Please make sure that you subscribe to our YouTube channel at the Kingdom Wealth Connector. This is already live on YouTube. It is already active in our playlist. So even if you couldn't catch all of it, make sure that you go back and rewatch it and share it with a friend of a friend and a family member too. Do not hoard this information. Do not be a gatekeeper, because we talk about y'all, okay? We already put all of our speakers' contact information in the chat. We will also send a recap email with the link to go back and watch it on YouTube, as well as everyone's contact information. And if you did not register via Eventbrite and we do not have your email address, please, please, please send me a chat, a private DM, or an email so that we can make sure we do not miss you. If we do not have any additional questions, comments, thoughts, or concerns, and all hearts are clear, we are going to say happy Saturday. I hope that you all have a wonderful weekend, and cheers to your home ownership journey. We look forward to talking to you soon. Have a great evening, everyone.